Welcome back to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Shield and Scott Campbell, financial planners for Align Wealth.
We're back. We were away for a week in Ontario, some time in Toronto and Ottawa. Wrapped up a solid weekend of some high rocks racing.
Yeah, the hybrid rock stars are back, Scott.
That's right. We won't bore you with the details, but it was a successful weekend. Chris and I hit the podium again in men's doubles, so we're stoked about that. And we realized that if we're going to get any better, faster, we need to be able to run faster, don't we, Chris?
Oh, yeah.
Yeah. We'll get there.
We'll get
But
there.
on to bigger and better things. We're going to put high rocks behind us and start focusing on some trail running and
That's
other
right.
stuff, right? Yeah.
That's right. Yep.
Yep. All right. Awesome topic that we're going to dive into today. This is actually going to be put together in a 3-part mini-series. We're going to dive deeper than we have into the topic of investing. And we feel like within this 3-part little series that we're going to put together over the next 3 weeks, we're going to give you everything that you need to know about the investment landscape, your options and choices, and how people are typically invested right now. Chris, why don't you tell us how we're going to put this all together for our listeners and why this could be a value for them to tune into really all 3 ideally.
Yeah, I mean, you got to listen to all 3. Sorry, guys.
Yeah, you have to.
You have to.
Requirement.
We'll start with this. We'll say that if you don't know how you're invested right now, it's very likely, probably about a 96% chance, according to the stats we looked at, that you are invested in what's referred to as an actively managed portfolio. So most people in Canada are in actively managed funds. We are going to dive into that topic today. If you fall outside of that and you have chosen to move away from active management, you're likely in a more passive or what people might refer to as an index portfolio. We're going to touch on that. And then on the third episode, we're going to dive into our philosophy and where there are similarities and differences between these two kind of common camps of passive versus active and how ours is a bit different.
Yep, lots to dive into. Yeah, if you're sitting there saying, all right, what does active mean? What does passive mean? I have no idea. We're going to try and cover this all from a really high level to get you up to speed of how and why you're invested the way you currently are. We'll leave you with some takeaways to go and figure this out on your own and find out if you don't already know. But like Chris said, if you aren't already crystal clear on how you're invested, there's a good chance that you might not be in a optimal portfolio from our perspective anyways. And we're going to give you we're not going to stand up on our podium here and talk negatively about any one company or investment style. We want to just bring the data and the evidence to support what we're seeing and how that shaped our current philosophy on how and why we make the recommendations that we do for how to invest.
Yep. Well said. So I think we got to start with a definition here. So let me try to paint this in as plain of English as possible. When we refer to active management, what we mean is that your cash is being invested into a fund. That fund is being managed by a team of analysts, portfolio managers, CFAs, etc., that are trying to make active decisions to beat the market. The market we could interchange with, say, the index. If you wanted to. Yeah, an index. Like, for instance, we could say the S&P 500, which is a collection of 500 companies in the U.S. Your actively managed fund might be a U.S. equity fund that their goal is to exceed the performance of the S&P 500 index.
And how are they trying to do that? By being actively managed.
So they are trying to make active decisions to time the market, predict the future, guess or speculate about which companies are going to outperform other companies. And they are constantly buying and selling and trading securities to try to get their investors the best return possible.
Yep. So in many cases, they're trying to overweight on some companies based on market commentary or underweight others or hold more cash on the sidelines because they want to have I heard the term at a recent event that we were at, dry powder is what they were referring to as cash, having cash on the sidelines, being able to make a decision on what to buy next when there's a reason to do so based on commentary and insider information and all the things that they get the data points from to indicate whether or not they should make an active decision on a daily basis of what to hold and what to sell and what's the objective that they're trying to achieve.
yeah, they're trying to get their investors a better return than the index net of fees,
Net of fees. That's the key there
right?
for sure.
The key is that as you would imagine, if you have a team of people that are highly educated and have their finger on the pulse of the market and are doing active research and analytics of what to buy and when and sell when, you would expect that those professionals are going to cost you quite a bit of money
Hmm.
to employ. And obviously the whole fund could be hundreds of millions of investors in that fund. You're all sharing in those costs, but the costs are real.
Yeah. So I think it's natural for us to maybe pause and say, let's talk about why it inherently makes sense, or it should make sense, that if we can hire a team of really smart individuals, got CFAs and those with PhDs in finance and you name it, right? Like smart individuals that do this for a living. They went to the highest levels of education. They have all the access to data and research and AI. Like they have everything. You think it's reasonable to assume that with all that information, all that expertise, that they surely should be able to make decisions to generate a better return than what the index, or just called the market, delivers, and get a higher return net of fees, of course, afterwards. Like that inherently kind of feels like that should be able to do that, right?
Yeah, I would think so. It's like, well, hey, I couldn't do it myself as a retail investor, as a person with no interest, or like if you're a listener, if you're like, yeah, I don't care what the markets do, I don't watch that, but hey, I'm going to hire a professional that can do that. You might think, yeah, well, hey, that's probably money well spent. Let's look at what the stats show. Let's look at what the evidence shows. So, couple ways we could look at that, right? We can look at past performance, and we could base our decisions off of that and saying, hey, this fund manager or this team of fund managers on this fund has had, a good track record of outperforming the market. And that might lead you to want to invest in that fund,
For sure. Yeah.
right?
Yeah. I think we can dive in more detail, like all the reasons why I think active management, active investing is still so prevalent in the Canadian space. But maybe on that note, we can actually kind of talk about some of these key stats when it comes to the Canadian retail, kind of like called the fund industry right now. As this data came from PWL in a report that they did looking at 2025 year end, the Canadian retail industry made up about $2.7 trillion. A lot of money, right? Of that market share, currently, I guess as of the end of 2025, currently of those funds, about 77% of that market share is still in actively managed funds. Roughly, yeah, just over two, three quarters of Canadians are still invested into actively managed funds. And that's where, to your point earlier, Chris, in terms of that 96%, that's actually specifically rated to, if you're an investor at one of the big five banks, there's a 96% likelihood that you are probably in one of these actively managed funds versus being in something more passive in nature.
Yeah, it's pretty alarming stat. Well, I guess it's not yet because we haven't spilled the beans on what the evidence shows.
Yeah.
But currently, 77%.
Yeah. So, and I think we'll get into the reason why, but I would say, well, it inherently makes sense. These funds that, especially if you're with one of the big five banks and they're promoting these actively managed funds with higher fees, and we're going to touch a lot on fees here momentarily, but they are in the business of generating a profit, right? So that's their goal. Obviously, they're trying to get a better rate of return for their end investors, but as we're going to get into here with the actual data and the research, that's a hard thing for them to accomplish. But they have the size and magnitude and the marketing dollars to be able to promote these products to a very large customer base.
Yeah, for sure. Okay, so we've established there's a lot of people still invested in active funds. Let's look at some of what in our industry is probably one of the best measures of the performance or history of active managers. And so there's a site called Spiva, or a scorecard called Spiva. It's the S&P indices versus active, and they've been tracking and benchmarking active managers versus their passive benchmarks for years. Okay, so the 2025 Canadian version was just released, and What it shows is that over the last 10 years, less than 2 out of every 100 Canadian equity mutual funds beat their benchmark. So 2%.
Only two.
2% of actively managed funds in Canada, Canadian equity mutual funds, beat their benchmark.
Over the last 10 years. And I see here in 2025 alone, an average of 85% of Canadian active funds underperform their benchmark. So it's not even that it gets better in a smaller kind of rolling 1 year period. It's still pretty dismal of like
Yeah.
what the outlook is. Like if you only had a 50% chance that the fund that you're in has a chance of outperforming, that's not the odds you probably would expect to have. Going back to their point of like, this is a team of really smart individuals. Surely they're going to be able to do this at least over a 1 year period of time.
Yep. And this is not just strictly for Canada. Like our listeners might be thinking, like, well, Canada's like whatever makes up 3% of the world, market. What about the US? What about other places globally? The numbers are very similar. US is about 3% of US equity funds outperform the index. Globally, it's 2%, somewhere in there as well. So this is Canada, US, international, all of the active funds that are striving to beat those benchmarks are failing to do so very consistently over a 10-year period of time.
All those smart people, all that data, all that information, all these tools at their disposal, especially the power of AI these days as well. And with all that, the data still says that over a long enough period of time, they're going to lose.
And the math makes sense. Like there's 2 points I always like to make. One is that no one can predict the future. If you could successfully and consistently predict the future, we wouldn't be talking to you if we could do it, right? We'd be sitting with trillions of dollars if we could predict the future every time. So no one can do it consistently. That's just common sense, right? But then if we look at like the math of it, after costs, like the average actively managed dollar has to return less than the average passively managed dollar for any period of time. And what we mean by this, to kind of get into a little bit more detail, is like markets are efficient. That's our belief, is that markets are generally efficient. So all information that is available globally is priced in. So, relative price, or like the current price of a company that is listed on the stock exchange, that price reflects all relevant information. It's not wrong. But when active managers make trades, they are often predicting or assuming that the pricing is incorrect in some way. And they're trying to take advantage of that. Or they believe that the pricing is going to go up based on some earnings report or some other reason. But what we have to remember is that on either side of, there's 2 sides to the trade. There's a buyer and a seller. And for every buyer that believes that prices are fair for that security, there's a seller that believes that the prices are fair for that security to sell.
Yeah.
And so there's these trades that are consistently happening with active management, and it's a net zero game. And then we factor in the fee. Obviously, they're not gonna do better.
That's right. When it comes to fees, like let's shift to that in terms of talking about how those fees are having an impact. Like if the data is showing that 95% of the time or more, these actively managed funds are not outperforming the market net of fees, then then it would make sense that if you get market returns, you're going to get less that of fees. And that's where we have gripes about paying an active manager a higher fee to get something that you're not going to get over the long term. So it's inherently going to leave you with net return after a larger fee than you would if you did something more alternative, which we'll talk to in our next episode on passive, where we're keeping the cost of those funds a lot lower. So, Chris, why don't you talk about a little bit about like what the average fees are and how they differ from the alternatives?
So the average active mutual fund fee in Canada, this would be a typical like bank product. So if you're invested through one of the big banks in Canada, average fee is about 1.92%. This fee is referred to as the MER, or management expense ratio. And it's a fee that is never really, a lot of times, not communicated directly It's never shown on any of your statements or on any of your fee disclosures that you would get from your bank. So it's kind of a hidden fee, unfortunately.
Yeah. That's changing though, right? With the new CRM rules that are coming out here
Yeah,
right away. That I think that's going to be broken down a little bit better, which hopefully should shine some light on what you're actually paying and who's receiving those fees, be that the fund manager or your advisor, and how much they're getting compensated as well.
for sure. So to compare that to other types of alternatives for investing, we could say, okay, well, what is like a traditional like passive, ETF fee? And that would be closer to like 0.25%. So
Yeah.
significantly cheaper compared to the actively managed mutual fund. And just to shed some light on like the impact of that,
Uh-huh.
right? This is where it gets really crazy. Like we think about these numbers like, okay, 1%, 1.5%, 2%, whatever. Like how much of a difference can that really make? Obviously, the more dollars you have invested, the bigger that impact is going to be. In this example, we're going to use round numbers. So we're going to say, what if you had $1 million invested and you earned 6.5% annualized for 30 years? If you had a 1% fee all in, your $1 million is going to turn into just under $5 million over 30 years, just 4.98 million.
Yep.
If that fee goes up to 2%, your 1 million turns into 3.74 million.
Mm-hmm.
If your total fee is 3%, your $1 million turns into 2.8 million over 30 years. So
Big difference.
a difference in 2% on total fee over 30 years is the equivalent of over $2 million in total dollars in the investor's pocket, assuming $1 million invested for 30 years.
That's significant.
Yeah, it's huge.
And it goes back to the point of if you were to pay that, say on average 1.9% that most of these, it's not even just the banks, a lot of these major financial institutions across Canada, you're familiar with the names, I won't pick on any of them, but a lot of them use actively managed funds. You're paying that 1.9, even upwards of 2.5. Sometimes we see MERs in the 3% range too, Chris.
Yeah.
It'd be one thing if you're, again, paying that higher fee and consistently getting a higher return than what the market was delivering, right? Then it would make sense, right? Then there would be an argument there to say, hey, this is a no-brainer. I'm happy to pay more if I'm going to get more. But when the evidence very clearly shows that that's not the case,
Yeah,
like what are you paying for at that point, right?
exactly. Yeah, and we've heard that argument over the years, like, well, I can pay, my fee's going to, cover itself because I'm going to get a higher return. Like, there's no option, there's no investment option or professional in Canada that can guarantee returns. If you have someone that's guaranteeing returns, you should turn and run, simply put, right? There's no guarantees in this world.
With that all said, why do we keep doing this? Why is this still so prevalent in Canada is actually in a bit of a worse spot from like an active versus passive, that ratio that I was referring to, about 77% of Canadians' money right now is still in actively managed funds. I think in the US, that's getting closer and closer to like that 50-50 threshold.
Yeah.
Canada's still fair ways behind in terms of, I don't know, maybe waking up to the fact that their investment strategy is less than ideal from a performance standpoint when you factor in these fees. Why is that still the case?
Yeah. Well, I'll give you a hot take.
Okay. Hot take time.
What are the biggest 5 companies, or a few of the biggest 5, like biggest companies in Canada?
Yep.
It's our big 5 banks.
Yep.
Our big 5 banks have a lot of pull on how things work in our country, in our industry, the financial industry. They are in the business of making money, as you've already said.
Yep.
Their influence is certainly being asserted here.
100% it is, for sure.
100%. So the big 5 banks are not going to turn around and say, oh, okay, we're going to cut our fees on our mutual funds because it's the right thing to do for the consumer.
Right.
They're just not going to do that, right?
And like there has been fee pressure over the years. Like they're like actively managed funds offered by banks. Those fees have slowly been coming down over the years, but still not to a point where it's still not a good value because they're still not delivering returns that are higher than the market on average over the long term.
Yeah, and there's other options that are available now at the banks, but they're never going to promote that or suggest that to an investor. They're always going to start with their default highest fee funds that are going to pay them the most, and their incentive at like the financial advisors or professionals at the bank are incentivized to do that.
Yep.
That's part of their job. So that's why we're still seeing it. Big reason.
Yeah.
There's a few other reasons as well. I think, some biases that we often see that lead to, chasing these returns. And that's, the first bias is really chasing past performance. And this is the biggest one. It's like,
For sure.
if we could find, those 3% of funds that outperformed in Canada or US equity, why don't we just buy those? Because they were able to beat the market over the last 10 years. I want that guy because he's gonna get me a better return than just average. And I'm better than average, Scott. So I want that return.
Yeah.
That bias is probably the biggest one that drives this continual search for active management.
Yeah, and that ties closely to like the recency bias, right? Like looking at what just happened in 2025, 2024, 2023, and like chasing country returns. Like, oh, the market in the US has been exceptionally strong. Like, we're going to chase that performance, or this fund manager did really well, so we're going to continue with them, or we're going to move over to them. My hot take here is that I think it's probably not overly common that it's the actual investor that's chasing past performance or that has recency bias. Because I think the majority of investors out there are trusting the advisor that is giving them advice and selling them the fund, that they're going to put them in the fund that is best for them, right? I don't think a whole lot of investors are coming to their advisor and saying, hey, I just did a whole bunch of research on a number of different funds across Canada, and I want to be invested in these funds. Sure, that happens, but that's not the norm. I think it's actually a lot of advisors who are trying to show their value by chasing past performance and making active decisions on top of the active decisions that are happening on a fund level. They're making active decisions from the actual choice of funds that are going to go into a client's portfolio. They're just as bad. They're using recency bias. They're chasing past performance to make this illusion that, they're going to be able to deliver a higher return for their clients.
Yeah.
Unfortunate.
It really is.
Yeah. Yeah.
So the only other bias that I wanted to mention is just this overconfidence bias that we all inherently have as individuals. So this could be from an individual investor level or the advisor level as well, right? And this kind of goes to, that I'm sure there's lots of analogies we can make, but when you pull drivers and say, hey, are you better than average as a driver? Are you a safer driver than average or better than most people on the road? Like 75% of people think they're better than average, right? But that math doesn't math, right? You can't have that. That doesn't work. So the same thing applies to our investing, whether it's an individual investor or the advisor. Like I said, we think we are smarter than most. Mm-hmm. And that can sometimes lead to wanting to make active decisions and try to outperform the average.
Well said.
A couple other stats I want to share on active management. There's lots of actively managed funds in Canada, mutual funds that are actively managed. There's new ones that are created all the time. Next episode, we're going to get into ETFs, exchange traded funds, a little bit more. Those often are almost miscommunicated as always passive or index-like, and that is not the case. There are a lot of ETFs that are also have active management components, but typically when we talk about active management, it's mutual funds that get picked on.
But there's also passively managed mutual funds that
there are,
right?
Exactly. It's tough to, there's a lot of nuance to this communication.
For sure.
But specifically with actively managed mutual funds in Canada, only about 50% of funds survive 10 years. So over half of the funds that are created today are not going to be around 10 years from now. And why that is? Why is it? Tell us why, Scott.
Well, if you only have a 3 to 4% chance of succeeding over a 10-year period of time, is it going to be in the fund manager's best interest to keep promoting a losing product that has a dismal track record? Unlikely, right? They're not going to.
And are investors going to want to invest in a losing track record?
That as well, right?
Right. So the fund managers, if they can't get enough active inflows into that fund for whatever reason, they're going to just close that down or relabel it and re-promote it in some different way.
Yeah.
So fund survival is a real thing. US and international is no different. The numbers are even higher actually than Canada. Like in the US, it's about 64% of funds don't survive 10 years.
Yeah, it's that's probably the most this stat that you're sharing, I think is just not talked about at all. And obviously fund managers aren't promoting the fact that they're closing down funds and then basically taking all the underlying holdings and just basically putting a new shiny wrapper on it and building some marketing material around it, giving a fancy new name. And when you charge as high fees as you do, you have the luxury of putting a lot of money behind marketing the actual fund, also incentivizing advisors to sell that fund. You hear that a lot in the active management space. Like active fund managers will wine and dine their advisors. Like they'll take them out to all the baseball and hockey games and the fine dining to get those advisors to use those actively managed funds because they got the very deep pockets to keep that going.
How come their pockets are so deep?
Yeah. Well, their fees are 1.9%. That's on
right.
average, right? So
That's right.
Yeah.
Okay, last thing I want to point out, and it kind of goes back to the bias of overconfidence. When we look at investing and our results in investing, we have to ask ourselves, is this due to skill or is this luck? And there's this interesting study from Fama and French from 2010. They studied about 3,000 US equity mutual funds, and they simulated what the returns of those funds would have been if there were zero skill. So if it was just strictly luck, zero skill, and they plotted those results versus the actual results. This is from almost 22 year period of time from 1984 to 2006, and the actual results are nearly identical. So what this shows is that there's really no evidence that trying to outguess the market adds any value whatsoever.
Right. Well, with that said, Chris, if active management is based on the data, like we're not just not making hot takes over here. We're trying to provide the data and the evidence to support why active management is a losing game. The obvious next step is if you can't beat the market, a lot of people out there, there's a lot of great educational material, DIYs out there saying, well, if you can't beat the market, don't use active management. You just got to be the market. And they start building the case for passive indexed investing, keep your fees low, invest into these indexes, and stop trying to outsmart the market and just set it and forget it for the next 2, 3, 4 decades. That's what we're going to be talking about next, right?
Yep.
But there's a big but here. We can't, because we're going to have some listeners that might already be investing passively, right? Would you agree?
Yep, for sure.
So they might say, all right, I don't need to listen to that episode or the third one because I'm not actively managed and I'm good. Right? So tee up our next episode, Chris. What are we going to be diving into on the passive side?
Yeah. So here's what you're going to hear. Passive, and what if you've done any research or asked AI about this, the likely outcome is that you've heard that passive is better than active.
Yep. Which we agree.
We agree.
Yeah.
But what we want to go into is a little bit more of the data that most people don't talk about, especially DIY influencers and the financial media. And what we want to talk about is that passive investing isn't as simple as it sounds. There are real active decisions that are a part of every passive investment strategy or investment fund. And all of these decisions affect your returns. So it's not as simple as black and white. It's just like active is bad, passive is good.
Yeah.
So we're going to go into the nuance of that and kind of see where passive investing, what passive investing truly means and where it falls short of what's actually possible. And we're also going to try to clear up some of this nuance around like ETFs being good, mutual funds being bad always.
Yeah.
Indexing and investing in ETFs meaning the same thing.
Yeah.
We're going to try to get into some of that detail as well.
For sure. And then finally, we'll save the details for episode 3, but we want to paint this picture now so that you know where we're going here. We've already covered active management and why we feel like it's less than the ideal route to go when it comes to having a successful journey as a long-term investor. Passive would be the next best stop in our opinion, but we're going to break that down in more detail and give you some information that you need to know. And then in part 3, on our 3rd episode of the series, what we want to do is kind of bring this all together, talk about, again, our investment philosophy. And I guess to oversimplify it is trying to bring in some of the best of both worlds that we like and leave behind what we don't like about both of those worlds, and kind of summarize that in our 3rd episode. So,
all right, let's leave it there for today, Scott.
Sounds good. I think we've covered a lot. Thank you for tuning in. Hope to have you join the ride for episodes 2 and 3 of this mini series, and we'll look forward to seeing you guys next week. All opinions expressed on the Cairo Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.